Today, we are together announcing an investment package to mobilize €4.7 billion in South Africa, and this is in both our interest. It includes funding for the clean energy transition, but also funding to boost vaccine manufacturing. South Africa wants to protect the health of its people as well as your autonomy and your local industries.
The European Union has reaffirmed its commitment to deepen relations with South Africa.
Now, European Council President Antonio Costa made a phone call to President Matamela Ramaphosa amid the fallout with the U.S.
Yeah, Costa vowed to strengthen relations with its stable and reliable partner.
Washington thought South Africa would wait. It didn't. While the United States debated strategy, Europe moved first, placing $5 billion on the table with no hesitation. Power grids upgraded, ports expanded, industry revived, and South Africa said yes without looking back. This wasn't about loyalty, it was about timing.
The Southern African Development Community, of which South Africa is a member, is signing off a so-called economic partnership agreement with the European Union to bring down trade barriers and reduce tariffs.
The EU is the African bloc's largest trading partner, with annual trade totaling over R1 trillion. The European Union Commissioner for Trade, Cecilia Malmström.
Europe showed up with capital. The United States showed up with words. And in today's global economy, that difference decides everything. South Africa didn't turn against America. It simply moved forward and left Washington outside the room, because in the New World Order, influence isn't inherited. It's invested.
The European Union has announced almost €5 billion of investment in South Africa. European Commission President Ursula von der Leyen unveiled the plans to support green energy and vaccine production during a visit to Cape Town. South African President Cyril Ramaphosa said the bilateral summit comes at a time of economic nationalism, referring to tariffs imposed by U.S. President Donald Trump. Von der Leyen said the EU was eager to deepen its relationship with South Africa.
For years, South Africa balanced carefully between global powers, maintaining relationships across continents while avoiding the appearance of allegiance to any single bloc. That balance shifted the moment Europe made a move the United States did not anticipate, and South Africa accepted it without hesitation. The announcement came quietly. Europe committed a $5 billion capital injection into South Africa's industrial, energy, and logistics sectors. Official statements emphasized cooperation, modernization, and shared economic priorities. Yet beneath the diplomatic language lay a clear message: South Africa had chosen a direction. And it did not include Washington at the center. The United States was not consulted. South Africa's decision was not impulsive. For years, policymakers had grown frustrated with conditional partnerships that promised support but delivered delays, restrictions, and political friction. Development plans stalled, infrastructure financing remained uncertain. Strategic sectors faced regulatory pressure tied to external priorities rather than domestic needs. Europe's proposal arrived differently. The funding package focused on tangible outcomes: power grid upgrades, port expansion, rail modernization, industrial zones. Linked directly to export corridors, no symbolic language. No ideological framing, just capital, timelines, and implementation guarantees. South Africa recognized the difference immediately. Europe framed the investment as mutual necessity rather than assistance. Aging European industries needed stable supply chains. South Africa needed long-term infrastructure capital. The alignment was practical, not performative. The United States observed the development with visible discomfort. For decades, Washington had assumed its influence in South Africa was secure by default. Strategic alignment, shared trade history, and diplomatic engagement were treated as sufficient. Yet when Europe placed capital on the table, those assumptions proved hollow. South Africa did not reject the United States openly. It simply moved forward without waiting. The $5 billion injection flowed through European development banks and private consortia, targeting sectors South Africa had identified as bottlenecks. Electricity generation stabilized, logistics efficiency improved, manufacturing. Timelines shortened, each improvement compounded the next. Markets reacted quickly. Investor confidence rose as infrastructure risk declined. Currency volatility eased. Export capacity expanded. South Africa's economic outlook shifted from cautious to optimistic almost overnight. The United States struggled to respond. Washington issued statements emphasizing long-standing partnership and shared values, but values did not fund substations. Statements did not modernize ports. South Africa had waited long enough. Europe's involvement also altered trade patterns. As logistics improved, South Africa's exports to European markets increased, supply chains tightened, delivery reliability improved. European firms integrated South African inputs more deeply into production cycles. Dependence grew on both sides. This interdependence mattered. It created resilience against political pressure. The relationship was no longer symbolic. It was operational. The United States found itself outside this loop. American firms faced longer transit times, higher costs, and less favorable terms. Without direct investment leverage, Washington's influence diminished subtly but steadily. South Africa noticed the shift and adjusted accordingly. Policy frameworks began favoring partners willing to commit capital locally. Procurement rules emphasized infrastructure contribution. Strategic planning aligned with European timelines, rather than American expectations. This was not hostility, it was pragmatism. South Africa had learned that alignment followed investment, not rhetoric. Europe understood this lesson well. Its own history was built on capital flows shaping influence. By injecting $5 billion at a critical moment, Europe repositioned itself as South Africa's most reliable partner. The United States misread the moment. Accustomed to setting terms, Washington underestimated South Africa's willingness to choose differently. It assumed hesitation where there was resolve. By the time alternative offers emerged, the window had narrowed. South Africa did not reverse course. The investment unlocked secondary benefits. Skills transfer programs expanded. Local suppliers gained access to European standards. Manufacturing clusters formed around upgraded infrastructure. Employment increased in regions long constrained by logistical inefficiency. Each gain reinforced the decision. Public sentiment inside South Africa shifted as well. The investment was visible. Power outages decreased, transport delays shortened, economic optimism returned. Europe's role was tangible, not abstract. The United States watched its influence erode without a clear trigger point. There was no diplomatic rupture, no sanctions, no confrontation, just absence. Washington was left as Europe's $5 billion investment began reshaping South Africa's economic landscape. The longer-term implications became impossible to ignore. What initially appeared as a strategic funding agreement evolved into a realignment with consequences far beyond infrastructure. The most immediate change was psychological. For years, South Africa had been treated as a market to influence rather than a partner to empower. Europe's approach reversed that dynamic. Decisions were made jointly. Project timelines were respected. Local priorities guided capital allocation. This shift fostered a level of trust that South Africa had not experienced in recent external engagements. The United States, observing from the sidelines, struggled to recalibrate. American policymakers attempted to reinsert themselves through diplomatic channels, emphasizing historical ties and shared trade frameworks. But South Africa's response was measured and distant. The relationship was not severed, it was deprioritized. That distinction mattered. South Africa's planners now worked within European timelines. Regulatory frameworks aligned with European technical standards. Export strategies increasingly favored markets where infrastructure investments were anchored. The United States remained a trading partner, but no longer a strategic driver. Europe's investment also triggered secondary capital flows. Private European firms followed public funding into South Africa. Manufacturing plants expanded, renewable energy projects accelerated, logistics companies upgraded regional hubs. Each new project reinforced Europe's presence and diluted the influence of partners unwilling to commit similar resources. The compounding effect was powerful. South Africa's risk profile improved as infrastructure reliability increased. Financing costs declined, credit outlooks stabilized. These shifts attracted global investors who viewed South Africa as a gateway to the continent rather than a peripheral market. The United States felt the consequences indirectly. American companies faced stiffer competition from European firms embedded in South Africa's growth cycle. Procurement preferences tilted toward partners already contributing to national development. Market access became conditional on participation rather than entitlement. South Africa had learned that leverage flowed from contribution. The geopolitical impact extended beyond economics. South Africa's voice in international forums gained confidence. Policy positions reflected greater independence. Alignment was based on interests, not expectations. Europe's backing provided strategic depth that reduced vulnerability to pressure. The United States recognized the danger of exclusion without direct investment influence. Washington's ability to shape outcomes weakened. Traditional tool statements, incentives, symbolic partnerships lacked traction. South Africa's trajectory was now anchored elsewhere. This shift influenced regional dynamics. Neighboring economies observed South Africa's progress closely. Infrastructure corridors extended beyond borders. Trade efficiency improved regionally. Europe's investment indirectly enhanced integration across southern Africa. The United States risked losing more than a single partnership. South Africa's experience became a case study. It demonstrated that alignment could change quickly when material needs were met decisively. Other African economies began reassessing their own partnerships, prioritizing reliability over rhetoric. Europe understood the significance. It did not overplay its hand. The investment was framed as long-term cooperation rather than dominance. Governance structures emphasized transparency. This restraint prevented backlash and sustained goodwill. South Africa responded with consistency. Policy continuity reassured investors. Regulatory stability encouraged expansion. The economic momentum gained credibility. Growth projections improved not because of optimism, but because constraints were being removed. The United States faced a narrowing window. Attempts to propose alternative funding packages emerged late and fragmented. Without the scale or speed of Europe's commitment, these offers struggled to gain attention. South Africa, already executing projects, saw little reason to delay progress. The exclusion of Washington became normalized. American influence faded quietly, without confrontation. Over time, absence replaced tension. South Africa's strategic discussions simply no longer centered on U.S. participation. This normalization was perhaps the most significant outcome. Geopolitical shifts are often dramatic. This one was procedural. Meetings proceeded, agreements were signed, projects advanced. The United States was not opposed, it was irrelevant. South Africa's confidence grew alongside results. Energy reliability improved. Logistics bottlenecks ceased. Manufacturing output increased. Employment rose. These tangible gains validated the choice to align with Europe. Public perception followed outcomes. The investment was not debated as ideology. It was experienced as improvement. Political resistance softened. Economic pragmatism prevailed. The United States watched as leverage slipped away. The realization set in slowly. Influence could no longer be assumed. It had to be earned through participation, not precedent. South Africa had not rejected the United States. It had simply chosen the partner that arrived prepared. As Europe's presence solidified, South Africa's strategic posture evolved. The country positioned itself as a bridge between continents, not a subordinate within any bloc. Europe's capital provided the foundation. South Africa's agency shaped the direction. The $5 billion injection was no longer just funding. It was a pivot, and as the global balance adjusted, one lesson became clear. In a world driven by execution, those who hesitate are not opposed, they are left out.